Okay, so with a trend line is a diagonal support and resistance. Okay.
Okay.
Like how we have our support and resistance like this.
Mm.
At the top, you have support. The down, sorry, at the top rejection, you have resistance. And at the bottom rejection, we have support. But this time around, you are not going to see the trend lines like this or channels.
Mm.
You're not going to see them like this. This is how you see them.
Okay.
This is
Those
the
are
normal.
disturbing us.
They're interrupting it. Okay, let me change my location so that. No. It's not the media, the social media side. Okay, hello.
Hello.
Can you please hear me?
Yes. Very clear.
Okay. So the general support and resistance that we know at the bottom rejection is called support, at the top rejection is the resistance.
Yes.
But this time around, we are going to see them as slanted.
Okay.
So this is how a trend line looks like. Okay. You see?
Okay.
So this will be a resistance. Okay.
Yes.
And then when it comes to the down like this, it will be your support because the bottom.
Okay.
Okay. So now one rule about using trend line is when you are drawing the trend line, okay, at least the trend line should touch 2 or 3 of the wicks. When you're drawing the trend line.
Okay.
The wicks of the market, okay, of the candles, at least 2 or 3 should touch it.
Okay.
You see, you can have one touch over here, second touch, and then a third touch. And when you're drawing a trend line and you are finding difficulty in placing it on the candlesticks, it's wrong. Okay. You don't force the trend line into the wicks. They should follow it. The trend line should fall on the wicks automatically.
Okay.
You shouldn't find difficulty in placing them on it. Okay.
Yeah.
So look at something like this. You see how it's flexible by touching it. At least 2 of the wicks are touching the trend line.
Okay.
Okay. So when you draw a trend line like this, and then you are waiting to take a trade on a trend line like this, you wait for the trend line to be broken. Okay. Then you have a retest like this before you can join the trend.
So retest, you wait for it to go down and come back or one. This thing is okay. One is come. One, I think, bull candle. We'll go back and touch it, or the whole.
Yeah, sometimes one big candle will do the retest.
Okay.
Sometimes you won't even get a retest perfectly. You get something like this as a retest. Okay. Sometimes it will be something like this. You won't get a perfect touch.
Okay.
Okay. So once there's a breakout and a candle closes below, and the next candle too closes below, then maybe you can join, or you wait for that candle to pull back. But if you don't get a pullback, there's no problem.
So when you
When
get the first candle close, that is the red one. Let's say the bear.
sometimes the one closing after the breakout could be a faking. Okay. So if you don't get a retest and the market goes and leave you, you don't chase it. Okay.
Okay.
When you get a breakout and then it's going like this, and you don't get an entry, just wait. The market will do something like this. You'll probably have a pullback as either a wedge, something like this. You get something like this. Then this one's breakout rather will give you an entry. Okay. So if you don't get an entry immediately, don't chase the breakout. Sometimes it could be a faking. It can do something like this. Then it goes back. So sometimes trend lines, it can fake you out, and then you think it's going your way, but it will come back, and then because you didn't get a retest, that's why they say the retest is very important. If you don't get a retest, this thing can happen. And what if you had entered on the first close of the candlestick? Okay. So with trend lines, when you're using trend lines, you wait for a breakout and then see a proper retest before you join.
It means that if you are using 1 hour time frame, you have to wait for about 1 hour time.
No. The retest can take maybe 3 hours or 4 hours, depending on when the markets want to come back and do the retest. The timing doesn't care. The timing is not a factor. The retest is upon what the market wants to do. It's not what you are waiting for the market to do. Okay.
So you have to wait. If it will take 3 hours, you have to wait.
You have to wait. This business is a lot of waiting and patience. If you don't have a train home, you will always be losing. Okay. So if it's 1 hour time frame,
yeah,
and then the retest is taking 3 hours, 5 hours, it's not your fault. And it's not because of the time frame, it's because of what the market wants to do. And then you have to wait at your entry. When the market comes there, you kill it. If it doesn't come through, then you let it go. You get another opportunity for trading.
But will it be instant where the market too will not reach 1 hour and come and retest?
Anything can happen. It can break it within 30 minutes and then give you another 30 minutes in retesting, or break it in 5 minutes and then test back. Anything can happen. It's Forex. So when a breakout happens, the retest, there's no timing on it because you don't know whether it will come back or it wouldn't come back. So you're just waiting for a retest. If it takes 2 days for a retest, fine.
Wow.
If it takes 1 hour to fine.
Okay.
So until you see the retest, you can act. But if you don't see the retest, you don't have to act. Yes.
Okay. Nice.
So in drawing trend lines, you pick your tool, then you find the peaks of the wicks of the candles, then you place it.
So we have
You don't have
plenty
to.
picks. We have
Have
plenty.
what?
We have plenty picks. So you like that one, you see, you have one. And this one, if you also start from this current one, or if you go back
This,
more, you see a lot of them too. So which is the most appropriate one to pick?
which of them?
Which of them is the most appropriate one? You see, this one is the, somebody can also start from the current one, the last two from the going front.
This one.
Yes.
This is a higher time frame. So you are looking for the direction the market is going.
Okay.
So you can't see the direction from this side. The trend line, you can't see it from here and then just decide to pick only here.
Okay.
Okay.
Yeah.
So you pick from afar so that you'll be sure that yes, the trend is indeed bearish or it's just a faking trend that you are seeing.
Mm.
So no matter how long you can extend your trend line, whether from the past or into the future, it's no problem. You just want to know the direction of the market.
Yes, yes.
Okay.
Okay.
And then the trend line, the rule is that at least it should touch two of the peaks of the candlesticks,
Okay.
either two or three, at least two.
Mm.
So if you should come and pick it over here, okay, over here too, you are getting the, if you should pay from here, you are getting the two touches,
Mm.
one and then two. Let me zoom in so that I can see it properly. So first one and then second one. So it's still valid.
Mm.
It's still valid. And that one too, you can pick from here.
Mhm.
Whether from here. Or you pick the major ones. Okay. So the major trend, this is the major trend. And then the wicks. So you have one, two touches. So all that you're waiting for is for the market to come here. When it comes here, the same rule of support and resistance that says that a support or resistance should be tested, a support or resistance zone should be tested, should not be tested more than 3 times. Okay, it's the same thing over here. So if you had your first test, second test, third test, on the next testing that is coming, you should be cautious. Okay,
Mm.
this is a first test, second test, third one. So the fourth one that will come, you should be very careful of what's going to happen. You just have to look at the reactions that is going to have on this trend, on this resistance.
Okay. Okay.
Because on the fourth time, anything can happen, whether it will break or it will reject it. That one you don't know. So on the fourth testing of a support or a resistance zone, you have to be very cautious. So this one, if you look at it, you have a first test, second test, and this is your third test that is coming.
Mm.
Okay. So the third one. So the third one, you can either wait and see whether it will hold or it will break it. When
Mhm.
it breaks it like this, when it breaks it like this, you wait for a retest. Okay.
Okay.
It breaks it, you wait for a retest before
Mm.
you join.
Mm.
If you don't get a retest, you just ignore it and then you let it run. The
Mm.
market itself will come and create. The market itself will fall, come back, give you another entry opportunity. Okay. So when it breaks, if you don't get a retest and the market leaves you, you don't have to be panicking that, oh, the market is going to have to catch it. No, 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 no. Otherwise, it will be like you are catching a hot knife falling from the skies.
Mm.
And imagine cutting a hot, sharp knife. You know what it can do to you.
Mm. 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 Mm.
So maybe you can get something like this along the breakout. And then
Along
when
the
it breaks
breakout.
out, because after this breakout, if you couldn't catch it over here,
Okay.
or if you didn't see a retest, and then
Mm.
it's dropping, just allow it drop. If it is truly a bearish trend, Okay, you get a pullback like this,
mm,
something like this. Then upon a breakout, you join this breakout instead.
mm. And that one, your chance of making profit is about 90%.
Your chance, yes, anything can happen.
But that one you'll be somehow sure that
Yes,
you
yes.
can make some profit.
You'll be slightly convinced that you can make
But
profits.
then you have drawn your major support and resistance on the time frame, higher time frame.
So that's what I'm saying, that with that one, instead of having your major support and this one like this one,
Yeah,
you can watch the direction the market is going. You can see that it's a bearish trend.
yes.
So instead of, okay, you can combine all the two. Okay,
Oh,
you can combine all the two.
okay,
So you have this one there, then you have your normal horizontal ones
okay.
inside the slanted one.
Hmm.
Okay. This one I'm teaching is because when you come to the lower time frame to find entry,
Uh-huh.
1 hour, you'll be using a lot of the trend lines. You see,
Okay, okay.
because inside the bigger channel, it's a bearish trend. So you can't be looking for wedges. Okay. You can't be looking for wedges.
But sometimes if you draw the major support and resistance on the daily time frame and you bring it to hourly one, see that you will not be seeing the lines. They'll be up, 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 and then the support will be down, 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 down. Sometimes if you want to scroll and get to that place, the chart will be becoming more smaller.
So if you do it on a higher time frame, a daily time frame, and you come to 1 hour
Yeah.
or 4 hour, you have it in mind that it is there.
Okay, okay.
So as you are in a small time frame and then you are working towards it,
Hmm.
as you are getting closer, it will appear. Then you remember that yes, it's
Hmm.
getting to either your support or your resistance.
Mhm.
Okay.
All right, all right. Good.
So I think now you know how to draw your
Yeah, the trend lines.
trend lines.
Yeah,
Yes, the
yeah.
trend lines.
Mm. So if you go to you go to the lower time frame, and that place, you don't need to draw this once again at that place.
I don't get you, please.
If you do it in the daily, you draw your
Yes.
trend lines and you go to 1 hour time frame, do you still need to repeat this trend line there? Or you will now be using
No,
these
no,
ones as your guiding point?
no. So the only time you have to use a trend line is when you are looking for the patterns.
Mm, okay,
Okay.
okay.
Because
So
we've
you can
identified.
question. So you can't use only the trend line to do your analysis.
Yeah.
I don't get
Hello?
your question.
Like you are doing your technical analysis. You
Yes.
can't just use only the trend line.
No. The trend lines will help you identify the trend. You see, trend lines, just like the name says. So it helps you like zoom out the trend of the market. Okay. Because sometimes you wouldn't see the direction of the market clearly. But once you pick a trend line, the tool, and then you draw your line along the direction, maybe when you pick it and then you are connecting the wicks, the major wicks, you tend to see that, oh, so the market has been going up or down. Okay. Because the wicks that you are connecting the wicks.
Okay.
Yes. So if you connect the wicks like this, then it tells you that, oh, for some time now, since February 2021, the trend has been what? Bullish. I'm sorry, bearish. And as you can see, it is forming lows, lower lows. Sorry, lower highs. Okay, lower highs, lower highs. You can see them over here. Okay. So you see how the trend line has helped you to connect the general trend of the market. So even if you see here too. Or you can see lower lows, sorry, lower highs, lower highs, lower highs, lower highs. Okay, so the trend line aids in zooming out the trend. So once you find out that the trend is bearish, with the help of your trend line, the major trend on a higher time frame, don't forget the trend is your friend. So whatever that is happening on the higher time frame is what will become your friend. Okay. Please, can you hear me?
Yes, yes.
Yes, we can hear you.
Okay. So I hope now you can see that the trend is bearish. It's coming down.
Yes.
It's coming down because this trend line has helped you to know the direction.
Okay.
But this one, you use more of the trend line when you are looking for the wedges, when you are drawing the wedges, because you have to connect the wicks. You have to connect the wicks so that you can know when to join on the breakouts. Okay.
Yes, yes.
So now that we know how to draw trend lines, please don't forget the major rule. When you're drawing a trend line, at least you should have 2 or more of the wicks touching the trend line. Okay. If you are drawing a trend line and the trend line doesn't, or the trend is not able to touch the wicks easily, it should be easy, flexible. You shouldn't struggle by pushing the trend line into the market. It should just be flexible. Once you place the trend line, it should touch the wick automatically. But once you are finding difficulty in placing them, then that means your trend line is having a problem. Okay. So now we'll start. We'll start with the chart patterns.
Okay.
But I prefer we do this one first.
Good.
We'll do the continuation patterns.
Okay.
These ones. We'll do these ones. Continuation patterns first. The name is continuation because when you see them in a trend, they help you join the major trend. Okay. The whole idea is about knowing where the direction of the market is,
Yeah.
and then joining that direction, that major direction.
Okay.
So on daily, when it is bullish on daily, these patterns help you find entries, okay, on the bullish trend. When it's a bearish trend on daily, these same patterns will help you. Okay, see, you can see them over here. You see a rising wedge and then a falling wedge. So falling wedge, this one will be for bullish. Let me clear this thing. You see, it means that the trend was bullish. Then you saw some corrections over here, a correction, and then the breakout, the retest. This is where you enter. You enter here, and your stop loss will be below. How do you call it? the consolidation.
Mm.
Okay. And then if this thing shows that the trend is bearish, it's a bearish trend, then it got here consolidated. Then you found your wedge. So this is how you use a trend line. A trend line will help you draw this line like this. And then a breakout, you get an entry. Then your stop loss will be at the top like this. Okay. So I'll go and illustrate it, and then we'll see if we can find some on the chart.
Mm.
Then we'll call it a day, so that next time we'll brush over. When you have enough time, we'll brush over it again before we move on to the next chart patterns.
Mhm.
So as I was saying, the following wedges, let me do for bullish market. So in a bullish market, you have an uptrend, So this is how you see the bullish market: swing high, swing low, a swing high, a swing low, another swing high, swing low, swing high, swing low. So in this bullish market, anytime there's a swing low or a correction, that is where you find the wedges. So this is how you find the wedges inside the trend. You see the wedges doing something like this. The corrections. Okay. You see them doing like this. Okay, so you see this as your, how, let me see if it's a falling wedge or, so you see it as a falling wedge. Sometimes to me, the names don't the names don't matter, because the wedges, they all do the same thing. It's about knowing the structure. Okay. So once you know that your structure is bullish and you get a wedge and there's a breakout, that means it's continuing to be bullish. Then you get another wedge, breakout, correction to give you a wedge, breakout, another correction. Until there is break in market structure, that's when you say that the wedge has changed, or you don't expect to see a wedge to break to the top. Okay. Once there's a break in market structure, it says that the market has done what? Has changed its trend. Okay. So a swing to the top, an impulse swing, then you get a correction. Another impulse swing, you get a correction. Another impulse swing, you get a correction. So the corrections are the ones which forms the wedge. Okay, so the corrections will form the wedge. And then once the wedges break out, then you join the trend. Once the wedges break out and you have a retest, you join the trend. It breaks out, you have a retest. So if it breaks out, you get your retest, then you join the trend to the top. This correction gives you another correction. Then there's another breakout, retest, then you buy. It consolidates or corrects again. It breaks out, then you join the trend. So basically, the wedges, this is how a rising wedge is rising because, I'm sorry, falling because the correction, this is how it looks like. So like this, and then like this. So the wedge is falling. Okay, that's how it got the name. Falling wedge. So bullish structures gives a lot of falling wedges. So on the higher time frame, as you've come to identify the trend as a bullish trend, you've marked out your support and resistance, the old ones, and then the immediate ones. Then you switch down to your lower time frame. Then you go and look for, if it's a bullish structure, you go and look for bullish or falling wedges. Okay, you look out for these structures on the lower time frame. Then you mark them out. So when you go to the lower time frame, a bullish trend, and you go to the lower time frame, and then it's selling, you don't care because the selling will give you a wedge correction. Okay, when you give the wedge correction, it breaks out. That's when you join the buys. Please, did you get it?
Yes.
Okay, I'll go over it once again.
Good.
So in a bullish trend, okay, where the market is forming a high, a low, a higher high, a lower high, higher high, lower high, higher high, lower high. On the daily, on the higher time frame, you get your trend correct as a bullish trend. Once you come to the lower time frame, you are coming to look for falling wedges. Okay, you see a buy because it's a bullish trend. You see a bullish move, then the sell. You shouldn't confuse yourself with a sell that the market is selling. No, your higher trend or your higher time frame says that the trend is bullish. So you are coming to look for bullishness only in the lower time frame. And then how then do you look for this bullishness? When you come to the lower time frame, any sell you see is giving you a correction in the lower time frame. Okay, so you come to the lower time frame, you see a swing high, then you see a correction, a sell. With that sell, you just pick your trend line tool and then draw the trend line from the highest peak of that sell, and then be waiting for the breakout of that correction, which is the sell that you are seeing in a serious bullish move. So you see this, and then you just wait for a breakout. You might get a retest, then you join, and you exit from whatever target that you have, maybe your 30 pips or 50 pips, then you are okay for the day. Until you see another correction, you don't join any trend. You see the correction again, then you draw a trend line from the highest peak. Then you wait for a breakout again, then you join the buys. You are joining the buys just because the higher time frame, which is daily, is saying that the trend is what? Bullish trend. If you go and look for sales in a bullish trend, you have yourself to blame. In a bullish trend, you look for only buys. In a bullish market or an uptrend, you look for only buys. If you see a sell, it is an opportunity or a correction for the buys to continue. So we'll go to the live, you look for a bullish market, a bullish trend. Then we'll do our analysis and then see if so evidently this tells you that it's a bullish market.
Yes.
Because you can see that it's going up. So your trend line is helping you indicate that indeed this is a bullish market. Okay. If you are not okay with it, if you are not okay with just one trend line, you can decide to pick two.
So this one,
okay,
doesn't mean that at the end of the day, the market will move to that place and retest the line.
At the end of the day, you don't know what the market will do. Bear in mind, you are using the future, you are using the past to forecast.
The future.
But because you draw the line doesn't mean that the market is going there exactly to go and retest and then come back. Okay.
But for sure, the market will move up maybe in that day.
Yes, in that day, you are joining the trend just because the trend says that it's a bullish trend.
Maybe you will join and within 30 minutes time, the market will move to the bearish.
Yeah, then it means that maybe your correction the correction for the bullishness to resume didn't like end. It wasn't a complete correction. Okay. But once you get a complete correction and then you buy, you get a breakout and you buy, it will go to the top with you. But if you should buy, if you get a breakout and you should buy and it sells, that means the corrections wasn't fully done. You see. So with that one, you can't tell when the corrections will be over. It's just because you know that a wedge has been created and then there's a breakout, a retest, and then you bought and then selling. So that's why you have to always take into factor your risk management. So now we know that our trend is bullish.
Yes, yes.
We'll go to the lower time frame, either 4 hour. Let's go to 4 hour. Still loading. So with 4 hour,
or 1 hour.
yes, whatever you are doing on 4 hour, you can do the same thing on 1 hour. So as a bullish trend, this sell you are seeing here, this sell, it doesn't concern you, okay? What you are interested in is the sales. You just, once you see the sales like this, you just pick your trend line to, then you find your falling wedge, okay? Because, oh, come on. So this is your trend line too. And this was where this bullish move. Remember, the market is a bullish market. So you are looking for what? Buys only. So you didn't catch this buy. Okay. And then you saw that the market started selling off from this highest level. All that you do is you pick your trend line to draw your wedge. Okay. You draw your wedge. Then you're waiting for this trend line to be broken before you can join the buys. Please, are you getting me?
Yes, yes, yes. You don't need to join the sellers.
No, you don't need to join the sellers. What if you join the sellers and then a bullish move resumes? So in a bullish market, you look for only buys. And how do you look for the buys in a bullish market? Is by drawing the wedges, the trend lines on the corrections that you see. So if you come to the lower time frame, you can decide to do your swing high, swing low, swing high, swing low. Okay. So this swing low is giving you the correction that you need for you to join the buys. So you see, this is the swing high. The impulsive move, this is where the impulsive move ended. Then the sales began. These sales don't matter to you. As a beginner, the sales don't matter to you. All that you're interested in is the breakout of the sales. So let me write it here so that in a bullish market or in a bullish trend, or uptrend, you consider only buys. Let me capitalize so that you know that I'm shouting the buys. You consider only buys. Only you, if you go and chase sell and the buys resume,
You lose the
you have
money.
your own wahala.
Hmm.
And you look for falling wedges.
And that is the
You look for falling wedges.
downstream.
Yes.
Downstream is the falling wages.
The correction is the falling wedges. The correction. This is a correction. Because swing high, correction, swing high, correction, swing high, correction. Just I was saying, a high, a low, a higher high, a lower high, higher high, a lower high, higher high. Sorry, a higher low. Oh. A high, a low, a high, a higher high, a higher low, a higher high, a higher low, until you have break in market structure. That's when you can say that the trend for the bullishness is over. So you have your swing high. You couldn't catch the buys from here. So all that you have to do is you wait for a correction, and then the correction is when the sales will resume. But it's not sales that you are looking for in an uptrend or a bullish trend. So falling wedges, you look for falling wedges and breakout and retest of falling wedges. So look at something like this. This was an impulse move, then a correction. It gave you the wedge. Correction. You see, before the breakout, after the breakout, you see this candle serves as a retest, but it's not a perfect one. You can even call this one as a retest. It's not a perfect retest, but as time goes on, when you get a breakout, we'll tell you what to look out for to add to the breakout before you join the trend. So you get your breakout retest, then you join the trend. So this is how you look for buys in a bullish market. So see again, over here, after the buys were done, another correction again, another correction like this, then a breakout. You see the retest,
The blue one.
then the buys. You see, but this buy isn't, how will I say it? It wasn't enough like how this one bought. Okay, so mostly my boss Luis has something he says. He says that when the breakout happens, to know where to exit from your take profit, it should be the length. You see this length?
The length.
This length, the length that the impulse swing gave you before the breakout is also equal to the same length. You see? So you measure this length and then place it here. But sometimes not always the case that you get that same length. That's why I'm saying that sometimes you just have to stick to 50 pips. Because look at after this breakout and then a retest. If you were to use 50 pips, or you use your distance, your support and resistance. Okay. Look at this is the first rejection over here. You have a higher rejection over here into the future. You are waiting. Your second rejection, your second immediate rejection is here. This one, I didn't even look for support and resistance because I was teaching you something else.
Yeah.
But at the long run, I'll teach you how to combine all. Because after you found your trend and your support and resistance, when you come to the lower time frame, in the lower time frame, you find the immediate, you look out for the immediate support and then the resistances, okay? They're very immediate ones, so that when you are trading, those ones will become your exit and then your entry, like your exit points. Because if you had seen this resistance over here and then you buy from here, the old resistance would have been your exit point. Once it comes here, then you exit. Because once you exited, see how it started reversing again and then forming a correction, a pullback, forming a correction.
So this one would have even been more than 50 pips.
Yeah, it should have more than 50 pips. So even see. After this impulse move, after this buy, if you are looking for buy again, you just have to wait for this correction. So after every correction gives you the opportunity to enter the trade. So you see, after every impulse move, so you have to keep it in mind that when you get an impulse move, you get a correction. An impulse move, you get a correction. An impulse move, you get a correction. So for you to be able to join a trend, you wait for the breakout of that correction. Okay.
Go up or down.
So whether it's a bullish or a bearish trend, after every impulse move, you get a correction. Okay, so once you get a correction and it breaks out, then you join the trend. Okay. So this is just a typical example. So you can see this is an impulse move, and there was a correction to the down. Another impulse move. Let me use a blue line right. You can see an impulse move. There was a correction to the down here. Okay. Then another impulse move. Then there was a correction. Then another impulse move. So in a typical bullish market, this is what it does until there's a break in market structure. So look at, you had your correction, your impulse move. Instead of getting your correction, you see what the market did. It broke the market structure. How we can say the market structure has been broken. You see, instead of a new higher low, it broke it and formed a lower high or a lower low. Instead of a higher low over here, it broke it. And then look at, after breaking it like this, breaking it, came back to retest the old low and then dropped again until it started turning bearish. So in a bullish market, this sell that you are seeing here is just a short-term sell for you to be able to join the buys. So once you see selling happening in a bearish market, in a bullish market, you just pick your trend line. Then where the last stop or the last height of the bullish market, you just draw your trend line to there. Then you just be waiting. You just be waiting to see this breakout and a retest. So you see, you go your breakout and retest. Then you join. And then when you are joining, the last height that the market go to should be your exit.
The last previous height.
Yes, the previous height that the market go to before the consolidation and the correction. You see, So this was the last height after the impulse move. This was the last height it got to before the correction. And then see when it broke out, see where it came again. I hope you can see it.
Yes, yes.
So once the market gets here again, then you exit. Then you wait for another correction. Promise to give you another correction. There's another correction after this impulse move. After this impulse move, here is another correction. You see, so another breakout.
That one, there are no retest.
That's what I'm saying, that sometimes you won't get a retest. Sometimes you won't get a retest. So if you don't get a retest, you don't have to worry yourself by chasing the market, because another opportunity will happen, it will come by all means. So if you don't have a retest and then no entry, no problem. So you see the immediate high. You see how the market got there, broke it before dropping. So if the immediate high is your exit target, if you had entered from here, you would have made 59 pips, which is a lot of money.
59. Okay.
As a beginner, don't be looking to be chasing plenty pips. You get something small, then you get out. You get something small, then you get out. Because at the end of the day or at the end of the week, you combine everything that you made, and then you see your progress. It's all about being consistent, so that when you get a big account,
Exactly,
you'll be able to manage it properly.
So in a day, how many trades will one need to place?
In a day, you can take only one trade and you're okay. If you end up over trading, you end up blowing the account. So maybe you can trade just a day, 1 or 2, then you're okay. It's not by force to trade plenty. You pick what you make, then you close for the day. Another day you look for another opportunity, then you trade. In a week, you've traded 5 times. Then you combine your profits, then you are going for it.
Okay. Madam Carol.
Hello.
How many
I'm
trades
here.
do you want to how many trades do you want to do per day? I think one is okay
5.
for 5. I say one is okay for in a week you do 5.
No.
All right. I think that one depends on your strength too. If you will not be too tired. Because once
it's not about being too tired. If you want to trade plenty, you will end up doing a lot of errors, and then the profit that you make, you will lose all again. We have what you call over trading.
Okay.
If you over trade, you try to make profit, like you'll be chasing the market, and then when you end up chasing the market, it won't go well.
When you do 2 or 1, you are okay. If every day you do successful trade, you get $50. Next day,
Yes.
$50.
I have another mentor who trades only gold a day, and then he trades from just 1 p.m. and then stays in the market for 2 hours. Then he's done for the day.
Hey.
Just 2 hours trading a day, then he's done, and he makes his profit or loss. Then he's okay. Even though there are several pairs that he can trade, he trades only gold. So, and then he trades only 2 hours in a day, just 2 hours. Then he's done. Then he's gone to whatever he's going to do. So in a week, he will trade 5 times. But when he compounds his profits, it's more than what somebody is earning in a month or a year.
Maybe his money is big. The money
it's not about his money is big. It's about consistency.
Yes.
Being consistent is one thing, and then having a big account is one thing. If you're not consistent, how do you manage a big account?
Okay.
If you're not consistent and you are giving a big account, you blow it right now. It's about
So what
how
is
to
the
make
best
money.
time to trade?
It depends on your personality. Mostly this first thing is about personalities. But some people to trade are just the New York session, which opens at 1 p.m. and ends at 7 or 8 p.m. That's how some people trade. Some people to will open their will pick the learning session, which opens at 7:30 and then closes at 3 p.m. You see, so it's somebody is how people's personality are. They pick or based on your strategy.
Yeah.
You pick your trade at any of the, but mostly people recommend the New York session because at that time the London session would have been used to correct whatever happened during overnight. The
So
Asian
what is
session.
that time? What is the time?
London session is just our normal time, 7 a.m. or 8 a.m.
I thought you said
3
the
p.m.
New York session.
London session is used for correction of whatever happened in Asian session. And then the New York session is what the true intention of the market does.
That's the 1 p.m.
That's the 1 p.m.
1 day.
1 p.m. to 5 p.m. Okay,
5
or 1
p.m.
p.m.
around
to
this
8
time,
p.m.
right?
Around this time. So 1 p.m. is when some people love to trade. But it doesn't mean that when you trade at the lending session, you make your profit. When you know what you are doing, any session can profit you. But mostly, London and New York session has a lot of volatility. But that's when the New York people, Americans, that's when they trade, or that's when the world market starts moving from the London time, and then yes, 7 p.m. to 5 p.m. That's when the market starts moving. But from 8 p.m.
7 a.m. to 5 p.m. or 7 p.m.
7 a.m. Sorry, 7 a.m. to 5 p.m. Yes. So within this time, the learning session is from 7 a.m. to 3 p.m. Okay. And then New York takes over in between 1 o'clock to 8 p.m. or 10 p.m.
Okay.
Then Asian session takes over. So you have to find which session you want to patch yourself with that will you be profitable. And then pay your schedules. Because you can't be sitting beside a PC from morning to evening. You have to go and do your rounds. You have to take your kids to somewhere, either school, you have to go and pick them up. So you have to strategize as to which time frame that you want to trade in. And then if at that time frame you don't have an entry opportunity, you don't trade. So it's all about discipline and then following rules. If you pick New York session 1 p.m. to 5 p.m. and then you don't have an entry or a breakout at 1 p.m. to 5 p.m., you ignore the chart, then you go and do whatever you are doing.
Okay.
If you pick learning session, which is 7 a.m. to 1 p.m., and then or 7 a.m. to 3 p.m., and then you don't have a breakout of your analysis, or you don't have an entry for analysis within those hours, you don't trade. So as you're asking how many times you can trade in a day, it depends on what the market gives you that hours or that day. So if in a day you don't have an entry, you don't trade. If a whole week you don't have a breakout or an entry, you don't trade. There are days you can't find any opportunity, and there are days you find plenty of opportunities. It's the market. The market gives and then it takes. So if you want to be part of the people that the market takes from, then you can decide to trade at any time that you want.
Okay. Okay.
So I think we'll end for today and another time.
Please
so
send
on Wednesday.
Save it for me. Oh.
Okay, Mr. Johnson will save it.
Okay.
Thank you.
So when we meet on Wednesday, I'll go over the wedges again.
Yes.
Before we look out to other chart patterns. Because you have to understand one of the patterns before we move on to the another one.
Yes.
So we'll end it here and then we'll call it a day.